So I thought that I would start off with just some basic trend analysis in bear markets. And the reason I'm showing this is because it can help filter out emotion and help you stay on the right side of a trend change. And just by using just simple trend lines, the 200-day moving average, nothing really complicated, you can really ascertain when a bear market is either shifting this trend in a big way or is actually ending. And so if we take the 2008 bear market, there's two trend lines I'm going to point out, right? The black one, which really is about this A, B, and then the C wave went all the way down to here. And you can see that trend line is right about here. It was overtaken right here in late 2009, okay? The second trend line, which is your minor trend line, was really about the C wave of the 2008 bear market. And you can see this trend line was established right here. We had lots of activity around here. Let me go. Yeah, that looks a little better. We had lots of activity around here where we took back the 200-day moving average, retested it, broke out, and then went forward. So the first time, when this happened here in mid 2009, I mean, if you couple that with a 5-wave move, you have strong evidence to go long. Now, sentiment back then, anybody was in the industry back then, but it was awful. It was awful here. I mean, it was awful up until 2013 with a lot of the clients that I was working with, which is why it's so important to kind of address, use these simple methodologies, a couple of other methodologies to try and get on the right side of that trend. So I just wanted to point this out. When these trend lines get taken back, the 200-day, and we start seeing 5-wave moves, you know that something is shifting. Now, we saw the same thing happen in the COVID low. And anyone that was with us, we were expecting another low. This was tracing the 1929 first wave of that bear market, I mean, perfectly, all the way up until about September when it diverged. I wrote an article about this on the forum talking about the cycle and how it flipped. And if you're interested, you can go read it. But this was almost a picture perfect following of the 1929 bear market before the big C wave went down into 1932 or 1933. But anyway, we were expecting a C wave down. We weren't expecting like a 1929 scenario, but we were definitely expecting that. However, anyone that was with us knows that around April, we started nibbling, started buying Datadog in the 30s. And the reason why we did that is because you couldn't deny this trend change. We had the same trend line going down. Then all of a sudden, you can see how the market is reacting to it. We had a gap up and go above that trend line. And that's basically the market saying that something significant is changing. We're not just going straight down in a straight line. And so we ended up starting to buy based off of that. And this was the right move because we just kept going up until recently. So where we are now is a similar situation. We have a very defined trend line. We touched it recently and fell back, and also the 200-day moving average. And so for me, I won't start getting super aggressive on the long side until we start taking back these trend lines. And I promise you, when we do, there'll still be some naysayers, and we would just kind of use our analysis from that point forward. But this is going to be a very important moment, is taking back this trend line from the 2022 top. Because we're in this bear market, we have other indicators that we can use. Like this 4120 to me is incredibly important. This was the CPI high recently, and if we can take back that 4120, that's the market telling you that it's priced in the inflation that's causing the downturn in equities. If we can take back the 4205, that's the market telling you that it's priced in the Fed rate hikes. And all the rhetoric they're using, it's already been priced in as well. So those would be very significant psychological moments if and when we take those back. For us, above 4120, and we start flipping aggressively, more so to the long side, because we do have a very, very full corrective structure. So I just wanted to point that out. These basic trend lines, these very important key inflection points and downtrends are really worth monitoring, which we are as well in real time. Now, I actually have been talking a lot about this as well. We have a three-wave move off the low. And I think once we got this, I've been saying for quite a while, expect a very complicated market, which is this is nothing short of what we've got. We've got a very complicated, messy market. And it continues to be so because we not only get three waves up, but we get three waves down. We're just basically getting three waves up, three waves down, three waves up, three waves down. And it's a very indecisive market. Three waves in my world means that a multitude of directions can be taken. Once we get a five-wave move, then we have a trend and we can get accurate targets. We can really move in a more accurate fashion. But while we're in these three-wave moves, expect volatility, expect indecision, expect wild emotional swings, which I think everyone can relate to. I mean, back here in early to mid-August, everyone was talking about the low is in. And then all of a sudden we shifted down here, everyone's saying that we're going to new lows. And then within just a week, people are saying that the low is in again. And now we're back to going to new lows. And everyone has probably experienced a similar emotional swing. I mean, it's exhaustive. And that's very common within these three-wave markets. So the reason I'm telling you this is because, preparing for this webinar, I was going to put all the counts that I see on the board. I did that yesterday in a forum post. And there's one more I wanted to add, a fourth count. And it just got so messy that I was like, I can't show this. So I'm really trying to simplify this as much as I possibly can. So this is as simple as I can make it. These are the levels that matter. 3,900, 4,120. You notice we closed at 3,901, in a very classic market fashion. I want to see a sustained break. Keep in mind, just like we have false breakouts, we can have false breakdowns. We're talking about a sustained break below 3,900 is what I really want to see. And so let's assume that we power up and take back 4,120. If that does happen, these are the counts that I see potentially playing out. I'm going to use these angles because they're important to this. The blue and the green, all right? So we'll start with the green. The green says that the low is in. This is very much not the popular thesis right now. But how it would look is something along these lines. We have an A, B, C first wave, A, B, C second wave. We get like an A, B, C, which would basically be the A wave of this larger A wave. What I'm trying to say is we would be tracing a large degree ending diagonal, where I would expect the third wave probably into next year, probably around the 48, 4,900 level. Seems impossible right now, but just that's why we always follow the price trend. This count is still active right here. And so these counts become the primaries, the ones that we'll focus on if we take back 4,120. Okay. Right now, we're still in no man's land. We really are. But that's what the green count says. The blue count has us in an A, B, and then a C wave move up, probably into November-ish. These tan lines mark clusters, these time factors we've been using really to kind of stay on the right side of these moves. The next one's coming up in late September, early October. Then we have one here in late October, early November. Excuse me, what is that? Yeah, it's actually more around the mid. I'll switch it up. The closer we get, the tighter they become. But we usually see big swings around these tan lines, these tan bars. These are just cycle clusters that we're able to identify, inflection points. But it would be saying that we have one more big push with our longs before the B wave tops, and the real bear market begins. The C wave down, which would last, at minimum, late February, early March, probably into fall of next year. I don't want to try and put a time frame on that until we start getting confirmation. But above 4,120, we have very high likelihood, very high odds of going to the 44, 4,500 range, possibly even up to the 46.5 range, and a very prolonged potential B wave, or in this ending diagonal that would take us to new highs into 2023. So that's the way I want you to look at it, above 4,120. And we have very high probability upside for another month, 2 months up into this range right here. Okay. Now let's say that we do the opposite. We break below 3,900. Okay. Then we're looking at these two counts right here. And what that looks like is this was actually the top of a fourth wave. And we have a three-wave, fifth wave pointing us down to, at minimum, a double bottom right here. There's a lot of very strong like support clusters between 3635 and 3610. The lowest I see is going on this move would be 3485-ish. So it's somewhere in this range, which would set up a pretty epic buying opportunity, because this would either be the end of the bear market, or it would be setting up for a large degree B wave, unlike we've seen before, which would last many, many months. So anyway, the other scenario that I see potentially playing out, once again, we're in a three-wave market, so it's just, there's so many ways this could go, and this would probably be the most painful for a lot of investors right now, would be if we break 3,900 on a sustained basis, bottom in this 3,750 to 3,690 range, because everyone would be expecting a new low, at least a double bottom, and bottom here, and then take off in that C wave. All right, so it'd be an A, B, and a C. And so that's that's what we're looking at right now. Right now, we're closer to breaking 3,900 than not. But there's some very interesting occurrences going on in the market. A lot of very interesting divergences. I talked a bit about it with the VIX. You know, the VIX, which is looking at volatility 30 days out, it's not really moving that much as with this volatility. It was basically implying that, you know, traders are not expecting that much volatility. I mean, this was a huge move in the S&P 500, over 4%. The last time we saw that, the VIX was above 40. And that was in 2020, you know, and it stayed below 30 on this move, which was very interesting to see, you know. So we see that divergence going on. I'll get into a few more coming up a little later. The last thing I want to point out, which is one of the reasons why we ended up taking off our, you know, just logging some more gains on this hedge that we put on, is on a structural basis, it looks like we're coming to the end of the move. Also, these divergences, we're not really seeing the kind of move that we should see with the VIX and other areas that we'll get into a little later with this move down. And it seems that the pain trade right now is up. Everyone is short. Everyone is taking out puts. Everyone is expecting a new low. So definitely the pain trade would be up right now. So anyway, moving forward, there's something happening tomorrow that some of you are probably aware of. It's called the quad witch, the quad witching, which basically happens 4 times a year. And what this is, it has to do with options and futures, where options and futures contracts on stocks and indexes all come together on the same day to either roll over or expire. And so when we see these, you know, they happen 4 times a year. And the last time we saw it was at this low on June 17th, I believe. And the last time was here on March 18th. Now, also, these were the 2 biggest volume days this year, right on these days. So there's going to be, so expect a lot of activity tomorrow. But one time we saw a continuation of the trend, the other time marked a major low. And so we just decided to go ahead and take the gain that we had in our hedge, leave 10% on for tomorrow just to see how we go. And I think that we're getting closer to some kind of a reversal than not, if you ask me. I just don't see us going directly down from here. Could happen, but I just don't see that right now. So anyway, just keep that in mind. Expect a lot of activity tomorrow. So some interesting things I wanted to point out. The supporting markets, we talked about with TLT, which is long-dated bonds. Long-dated bonds are 100% determined by growth and inflation expectations. The farther out on the curve you get, the less influence it has by Federal Reserve moves, which is why you see phenomenons like the 2-year invert with the 10-year. The 10-year is controlled by growth and inflation expectations by the bond market, where the 2-year is more controlled by Federal Reserve policy, right? And so when you get out to the 20-year and beyond, I mean, you're talking only growth and inflation expectations are what's driving that, right? So what I want to point out is, you know, this scenario we've been tracking has been working out perfectly. I mean, we are in a 5th wave. It couldn't be more of a clear 5th wave. It's ending up as a diagonal. The thing about diagonals is they're very common for 5th waves, And when they end, you see sharp reversals. Also, more evidence of a fifth wave. We had peak volume on the third wave here, less volume on the fifth wave, right? As price goes lower than the third wave, you don't have as much force behind it. And also look at the momentum. I mean, just such a wide divergence. Everything you want to see to define a fifth wave. The structure is there. The symmetry is there, the volume patterns, momentum patterns. You know, if this isn't a fifth wave, I don't know what is. And what comes at the end of the fifth wave is the start of a new structure in the opposite direction. So maybe it's implying something about the Fed meeting next week. I really don't know. But what I do know is this is pretty clearly a fifth wave. I started personally on my own account going long TLT around this range. And we're also getting the MACD rolling over. What I find very interesting, this is the S&P 500. You know, as bonds go down, rates go up. And as rates go up, stocks don't like that, especially growth stocks. And as rates, think about it this way, as TLT goes lower, rates are going higher, which is causing equities to go lower as well. And look at this, rates are at their absolute highest in this entire cycle. And the S&P 500 is not making a new low. That is a very interesting divergence, if you ask me. And it's happening on a smaller level. Look right here, lower low. Rates were at their peak on September 13th, yet equities did not break that low. So a very interesting divergence. To me, that's telling me that the stock market is likely pricing in this fifth wave right here. And if you're paying attention, you know that it's also one reason why we probably won't go directly down to new lows, is favoring that orange count in my opinion, if we break 3,900 or some kind of sharp reversal. So the rates and bonds are favoring some kind of a bigger reversal, if you ask me. The US dollar, the DXY, we've been tracking this as well. The higher the dollar, the worse it is for equities in this market. And we have a clear five-wave pattern down. We tracked this. We have an expanded flat correction right here. Second wave that topped at the 76.4 retrace, which is a pretty deep second wave, but totally acceptable. I don't want to see us break above this 110, 110 level. I really don't. We really need to break below 107.585, which is really this low right here. If we break below this low, I mean, look, you got like a nice little head and shoulder pattern setting up. You know, that would be the end for the dollar, and it would be really good for equities. But we've been here before, right? We came to this situation before where we had this beautiful five-wave drop, and then a second wave just take off to new highs, right? So we really need this to be proven to us for this to happen. But so far, we have the pattern in place. We just need some follow through. Once again, is it going to come down to the Fed meeting? And would that be the catalyst? Who knows? And going on to oil, which is really the primary driver of inflation right now, and housing and the CPI. But the lower oil goes, I mean, that's getting taken care of with rates, very much so. Oil is another story. This pattern we've been tracking for quite a while. I'm an energy bull long term. I think there's some great values, especially with a long-term perspective. But for me, the lower this goes and stays range-bound for a longer period of time, the better off we are with inflation data. This has been the key driver for inflation. And we want to see it subdued. And it looks like it could even test the 77 range, which is totally fine with me. Like I said, sideways or down a little more. We don't want to go down too much, but 70s, 80s, totally fine. And the lower we go over the next month in this range, the better the inflation data is going to look. So all these supporting markets that have been causing this bear market seem to be lining up with some kind of a reversal in equities coming sooner than later, if you ask me. So that's my perspective of the broad market. I think really all that matters is, 4120, 3900, and then if we get 3900, then you come down to, is this all we're going to get is 37.5 or 36.85? If we were hedged, I'd be looking to take off the bulk of that around in this range right here. Most people will be looking for lower lows, but this is where I'd be looking to log those gains in a short. So, okay, moving forward, regarding a recession, this is very interesting times that we're in. This will go down in history as a recession because we have 2 quarters in a row of negative GDP. However, it will be the first recession in history where we saw 450,000 jobs created per month, industrial production go up 5%, manufacturing and services expand as well. So, I mean, what I'm trying to say is we're in this bizarro world of fiscal and monetary policy being created, creating all these anomalies. You saw companies in the 4th quarter of 2021 building up their inventories like we've never seen before, causing massive GDP growth. And now we're seeing the unwind of that. We're seeing export and import imbalances causing the GDP to shrink to negatives. But what really defines the economy shrinking is expanding, right? Industrial production, job growth. So reason I'm saying that is, when we are in a real recession, there will be no debate. No one will be debating, are we in a recession or not? No one in 2008 or 2009 was saying, is this really a recession? No, it is obvious to everyone, right? And right now, there is a debate going on. We have a headline recession, and then when you look at the data, we're seeing an economy that's expanding. It's expanding slower, but it's still expanding, which is why I always like to, just defer to the bond market when it comes to recession and recession predictions. This is all the bond market does. It's incredibly larger than the equity market. All they care about is growth and inflation. Very intelligent people, lots of money in the bond market, So what they say, I tend to agree with and follow. And so what we're looking at are the 10 and 2 year yield curves and when they invert. Now, remember, the 2 year is controlled predominantly by the Fed policy. The 10 year is controlled more by growth and inflation expectations. So when this turns red, we have an inversion. And we are fully inverted right now and stay inverted. And so the thing about the 10 and 2 year is it's the most popular predictor of a recession. The problem is that going back to the 1950s, there have been 2 instances where it gave a false positive, where it inverted and we did not have a recession. And also the average lead time to that recession is about 1.5 years. So can you really use that in real time? Not really. I mean, it's a good gauge. It's a good warning. But because of the lag time and the fact that it does have some false positives can lead you to maybe lean into your predilections and what you want to have happen, right? This is why I prefer to go with a 3-month and 10-year curve. So the 3-month and 10-year spread has a 100% accuracy. There are no false positives. And it gives an average lead time of about a year, which is a little bit more reasonable. And I want to point out that it has not inverted yet, right? And when this does invert, in my mind, we're on the clock for a recession within like the next year. And so what that would look like with our counts, if let's say we invert on this Fed, let's say they get aggressive and say 75 basis points, I don't expect this to not invert on that news. And if that does happen, I would expect some kind of bounce to be in the form of a large degree B wave, followed by the C wave leading us into this recession that it would be predicting. But I do want to point out that it has not inverted yet. And this is very important. This is the bond market saying that we're not 100% sure that this big recession everyone is talking about is going to happen yet. All right. So this is what I'm following for that indication. And we'll see, we'll have to see what happens. But I do want to point that out right now. Regardless of the debates, the bond market is king when it comes to recession predictions. And the last thing